your home, your child. Revenues bill. You bought that house 30 years ago. Maybe it was in Dublin, maybe in Cork or Galway, or a town in Leinster. You signed the papers, you paid the mortgage every month for 20 or 25 years, through recessions, through interest rate spikes, through years when money was genuinely tight. And now that house is fully yours. You have, at the back of your mind, a quiet assumption. When you are gone, it goes to your children. That is how it works. That is what you built it for. Here's what nobody told you. When you die, revenue sends your child a bill, a cash bill, due within 12 months of your death. And if your child cannot pay it, they sell the house to cover it. The house you spent 30 years paying off. On the 13th of May, 2026, the Central Statistics Office published its latest residential property price figures. The median cost of a home in Ireland is now €390,461. In Dublin, the median is exactly €500,000. The inheritance tax threshold, the amount a child can receive from a parent before capital acquisitions tax kicks in, is €400,000. Budget 2026 made no change to it. None. That gap between 500,000 and 400,000 is not an accident. It is a system, and most Irish families are walking straight into it without knowing it exists. Before we go any further, quick one. Drop the county you're watching from in the comments and tell me how long you have. Are you on a lunch break or are you sitting down for the full picture? I ask every time because the spread of where people watch from genuinely surprises me. Now, back to the numbers. Because they are worse than they look. Here's the part nobody is talking about. Capital Acquisitions Tax, CAT, is charged at 33% on the value of an inheritance above the threshold. That is the rate, not the threshold, the rate, 33%. The Organization for Economic Cooperation and Development average rate for inheritance tax across its member states is 15%. Ireland charges more than double the OECD average. The Law Society of Ireland has described the Irish system as a lethal combination of a punitive rate and a severely low threshold. And the threshold has not always been this low. In 2009, a child could inherit €542,544 from a parent before paying a single euro in tax. The rate at that point was 22%, not 33%. Then the financial crisis hit. The government cut the threshold and raised the rate. Emergency measures for emergency times. The threshold fell all the way to €225,000. The rate climbed to 33% and stayed there. That was over a decade ago. The emergency ended. The measures did not. The threshold has crept back up since. 280,000, then 310,000 by 2019, then 335,000 announced in budget 2025. Then 400,000 from October of 2024. Progress, the government would say. But 400,000 is still €142,000 below the 2009 peak. And property prices nationally are now 25% above their highest point during the Celtic Tiger boom. They are 178.8% above their post-crash trough. The latter has rungs missing. Every year the threshold stays frozen, another rung disappears. None of that, however, is the real issue. Here is where the story takes a turn. Most Irish families think they know roughly how this works. Parent dies, child inherits, tax applies above 400,000. Fine. They factor in the threshold and assume they understand their exposure. What they do not know, what almost nobody mentions until it is too late, is the rule that has been running quietly since the 5th of December, 1991. Revenue does not just look at what you inherit when your parent dies. Revenue looks at everything you have received from your parents since that date. Every gift, every contribution, every transfer of any kind. Think about what that means in practice. You are 50 years old. Your parents helped you with a deposit on your first flat in 2005, €40,000. They gave you and your partner money for your wedding in 2012, €20,000. They helped you through a difficult year in 2018 with a loan that became a gift, €15,000. You were grateful. It never occurred to you that revenue was keeping a running total. It was. That is €75,000 already counted against your 400,000 lifetime threshold. By the time your parent dies and the family home passes to you, your effective tax-free amount is not 400,000. It is 325,000. The difference is taxed at 33%. On a 500,000 euro Dublin home, your bill is now 57,750 euro, cash, within 12 months of the funeral. There is no payment plan. There is no grace period tied to your financial circumstances. Revenue wants the money. This is not an edge case. This is the mathematics of the average Irish family home meeting the Irish inheritance tax system in 2026. If this breakdown is what has been missing from your feed, hit subscribe. This channel covers Irish news the way it deserves to be covered. No spin, no hysteria, just the full picture. Now, back to the numbers. The dwelling house exemption is the one relief that can make all of this disappear. If a child who does not own another property has lived in the family home as their principal private residence for at least 3 years immediately before the parent's death, they can inherit the house entirely free of capital acquisitions tax. Entirely free. Most people do not know this condition exists. More importantly, most people do not structure their lives around it in time. The child has to have been living there for 3 years continuously before the death. Not after the parent gets sick, not after the house goes into probate, before. For those watching from the United Kingdom or the United States, this is the part that lands hardest. You left Ireland. You intend to come back. You plan, one day, to inherit the family home and return to it. The 3-year residency condition means that unless you moved back and lived there continuously for 3 years before your parent died, the exemption does not apply. You pay the full bill on a house you associate with every memory of home. That is the rule as it stands today. Everything we have covered so far is only the first half of the problem. The real story starts here. There is a second system running alongside the inheritance tax regime that most Irish families encounter when a parent needs long-term nursing home care. It is called the Nursing Home Support Scheme, known to most people as Fair Deal. Over 30,000 people are enrolled in it across Ireland right now. The average cost of nursing home care is over €1,000 per week. Under Fair Deal, the state pays the balance of care costs after assessing income and assets, but it assesses assets, including the family home. The contribution is 7.5% of the value of the principal residence per year, capped at 3 years, meaning a maximum of 22.5% of the property's value extracted while the person is still alive. On a home worth €500,000, that is €112,500 removed from the estate before death. After death, the remaining value, if it exceeds €400,000 and after prior gifts are counted, it often does, is taxed again at 33%. Two systems, running simultaneously. One takes a share while the person is in care. The other takes a share when they die. Neither was designed to be explained to ordinary households. Both are technically legal, which is technically the problem. There is also a 5-year look-back rule inside Fair Deal. Any assets transferred in the 5 years before a Fair Deal application are still counted in the financial assessment. The HSE and revenue are both counting backward from different starting points simultaneously, and neither bureau will volunteer the information that the other is doing the same thing. The latter is missing more rungs than most families can see until they are already halfway up. But here's what actually changes the outcome, and none of it requires wealth, only timing and knowledge. The dwelling house exemption, used deliberately. A child who does not own another property, who moves into the family home and lives there for 3 consecutive years before a parent's death, inherits the house with 0 capital acquisitions tax. 0. The planning has to happen years in advance, but it is real, it is legal, and it is used by a fraction of the families that could use it. The small gift exemption. Every person in Ireland can give any other person up to €3,000 per year, completely outside the capital acquisitions tax system, with no impact on the lifetime threshold. Both parents can give €6,000 per year to each child. Over 10 years, that is €60,000 moved outside the tax net entirely. It compounds. It does not vanish into the revenue calculation that starts in 1991. The Section 72 insurance policy, a revenue-approved life insurance product designed specifically to cover a capital acquisitions tax bill. The parent takes out the policy, the child inherits the house. The policy pays revenue. The house is never sold. It was designed precisely for this situation. It is fully recognized by revenue, and it is almost entirely absent from any conversation a bank or solicitor will have with an ordinary Irish family. The system is not designed to help you find these routes. That is not a conspiracy. That is how systems work when nobody has a financial incentive to explain them to ordinary households. Here is what this all means on the ground. Property prices in Ireland rose 6.5% in the year to March 2026. The national median is €390,461. The Midlands, Laois, Longford, Offaly, and Westmeath recorded the highest growth in the country at 13.4%. The affordability crisis that drove buyers out of Dublin a decade ago is now repricing the towns they fled to. In every one of those towns, the family home that a parent spent a working life paying off is quietly moving above the threshold that triggers the bill, the €500,000 median Dublin home, the 33% rate, the €400,000 threshold unchanged in budget 2026. The 35-year running total revenue has been keeping since 1991 that most families have never been told about. The fair deal contribution taken from the same asset before and after death. None of this was announced. None of it required a vote. The mechanism was already built. Every year that property prices rise and the threshold stays where it is, more ordinary Irish families move into exposure they cannot see, on a ladder where the rungs keep disappearing one by one. The next budget is due in October. Until then, the clock is running.